Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man, America's annuity agent, licensed in all 50 states. And this is the top annuity podcast on the planet. Today's topic is a very good one. It's timely. People are always calling me about long-term care. Fortunately, our guest today is arguably the top resource and expert in long-term care in the country. His name is Jack Lenenberg. You can find him at LTC Partner, singular, ltcpartner.com. And we'll have all of his information on the website, my website. But every single person for the past 10 years that's called Stan the Annuity Man, who's the expert in annuities, and they say, well, what do you think about long-term care? I mean, who do you, and every single person I send to Jack. So he's like me from the standpoint he tells the brutal truth. He does not mince words. He's really just not a salesman like I'm not a salesman. Yes, we do sell things, but we listen to you and we try to apply the right contractual guarantee for your specific situation, and we have no problem telling you if it doesn't fit. So with that introduction, I want to welcome Jack Lenenberg to the program. Jack, welcome to Fun with Annuities.
Hi, Stan. It's great to be here.
Jack is give us let's just start with a brief overview of long-term care. But before that, tell us a little bit about your background. I'm going to give it away quickly because he's a lawyer. His background, he's got a JD. He's a lawyer, long-term care, but I think that's fantastic. Tell us a little bit about yourself, Jack.
Well, thank you, Stan. I mean, I do have a law degree. I graduated from Boston University School of Law in 1997. I started in the financial services arena shortly thereafter in 1998, with a broad focus of, estate planning, life insurance planning, et cetera. Mm-hmm. But I developed a niche for long-term care insurance contracts, and so I started to focus heavily in the long-term care insurance arena by 2002. I've been an independent producer since then, okay, and I've been blogging and writing about long-term care insurance contracts for the past 24 years.
So you've seen it, done it, and forgotten more than most people will ever know about long-term care.
Probably true. Yes.
Absolutely. Well, and I like the fact that you only focus in that area because it's not a simple area. There's a lot of regulations. There's a lot of things that people need to know about long-term care. And one of the things that I always tell people, annuities solve for four things: principal, protection, income for life, legacy. And then I say at the end, the other L is long-term care, confinement care, PILL. But in a perfect world, annuities and long-term care is a supplemental coverage because it's not as good as traditional long-term care. Jack and I had a really good conversation about that the other day. But kind of take people through the product types that are out there, the solutions that are out there, and actually the overall environment of long-term care in the industry right now.
Okay. Well, I mean, let's first start talk about what long-term care insurance is at its core. I mean, it's tax-free dollars that will help uninsured should they be chronically ill, mm-hmm. should they either need help with two activities of daily living, or should they have a severe cognitive impairment such as Alzheimer's or dementia. And if your doctor certifies that you need help with activities of daily living or that you have a cognitive impairment, then you will be able to receive tax-free benefits for long-term care. And all long-term care insurance policies that are tax qualified, that adhere to these benefit triggers, I mean, your need for care does not have to be permanent. You just need your doctor to certify that you have an expected need for at least 90 days. And so all policies will adhere to this language. And, if we're trying to fund long-term care benefits, there's a number of policies today that are tax qualified contracts. I mean, of course, we have the standalone policies, which, just like a health insurance policy, auto insurance, homeowners insurance, no cash value, just you pay a premium as you go for the rest of your life. But if you need benefits, you receive tax-free benefits. And then we also have today, and these are becoming hugely popular, asset-based policies, also known as hybrid policies, where we're combining cash value assets, with tax-free long-term care benefits should you need care.
Okay.
So the asset-based policies can be either connected to a life insurance contract or an annuity contract.
Okay.
Such that if you don't need care, the premium that you've paid into the contract comes back to your estate at death. So those contracts today are, very popular, and the market has really moved heavily in the past 8 years, to the asset-based funding approach.
Do you think the reason for that is, we have 10,000 baby boomers hitting the age of 65 every single day. Do you think it's because people have worked so hard for their money and they've scrimped and saved and planned and done without, and now they're at this point where they're going to plan for long-term care? They just want to make sure that if the money's not used, it's going to go to somebody in their family. Do you think that's the main reason for that?
Oh, it's a huge reason. Absolutely, Stan. So I think we want to know that we're covered for long-term care. We don't want to be a burden to our children, to our families. But we don't know if we're ever going to need it. So I think it's human nature to think, well, I'd like to know that if I don't need it, I can get a return of my premium. Sometimes it's hard to just pay insurance premiums thinking we may never, ever, ever need it, and the money just goes away. Now, the other key part, I think, to this transition to the asset-based policies is the premiums are fixed and guaranteed, which is very important. So most of our clients, they want to know that everything is guaranteed.
Right.
There aren't any type of a trust me contract. Trust us that we won't change your premium. Trust us that your benefits will be paid out in the future. With the traditional policies, the main pushback we've received, especially over the past 10 years, the underwriters started to increase premiums dramatically on in-force policyholders. So every year or two, they would receive a rate increase notice of 10, 12, 15%, and you would have to either pay the higher premiums or reduce your benefits. And then once the policyholders start to receive these ongoing, they're not happy. So the traditional policies have no guarantees with regards to what the premiums will be in the future. And for baby boomers buying policies that they may have for 25 or 30 years, that is a little unsettling. So that's created the move to fixed and guaranteed policies today.
When you were talking about that, there's a lot of misconceptions in both the annuity industry and the long-term care industry. One of the misconceptions in the annuity industry is when you die, the evil annuity company keeps the money, right? And people think that's the only way that income can be structured. Of course, that's not true. The vast majority of what we do is when your Learjet hits the mountain, whoever's listed on your policy gets all of the money. The evil annuity company doesn't keep a penny, even though they're on the hook to pay. I'm assuming the same thing holds true with what you just said. I think a lot of people are out there saying, well, I'd never buy long-term care because, the premiums just keep going up and no one's ever going to get the money if I don't use it. And what you just smacked everyone in the face and woke them up is, no, no, no. No, that's not true. You can get a policy that has contractual guarantees that is fixed and is not going to change. And if you don't use it, the money goes to somebody, correct?
Absolutely 100% correct. 100% correct.
And see that,
So,
I think if we did one thing in this podcast, and we're gonna say it at the end too, is to dispel the misconceptions, the rumors, the misinformation of people out there talking about long-term care that have no idea what they're talking about, that you can get the contractual guarantees that are not going to change, and you can control the asset, which is great. Let me go backwards a little bit, Jack. When you mentioned the 2 of the 6 daily functions of life, let's be a little bit more rudimentary, fundamental here. Can you tell everyone the 6 daily functions of life?
oh, absolutely. So eating, bathing,
Mm-hmm.
dressing, toileting, maintaining continence, and transferring, or also known as mobility. So the act of moving from sofa to chair, up the stairs to the bedroom, etc.
So when you can't do those two of the 6, like you said earlier,
right.
that's the trigger point, right? So those are the 6 things that the doctor is going to look at and say, well, I sign off on the fact that they can't do 2 of the 6, which triggers the benefit, correct?
Right. That's one trigger. So there's 2 triggers. And
right.
To get into the race, you have to clear either one of these low hurdles. So the second trigger is you may be perfectly able to perform activities of daily living forever, but if you have a cognitive impairment, if your memory is slowing down,
right.
and Alzheimer's, dementia,
Mm-hmm.
organic brain syndrome. So if that's the case, benefits will be triggered as well. And it's your doctor, and I get this question a lot. A lot of clients will ask, well, Jack, who makes this determination? I mean, I'm sure the insurance companies is just going to say that we're fine. No,
right.
it's
the evil insurance company. They're always out to get you. Yeah.
Of course. It's a fair question.
Sure.
But it is your doctor who makes that determination. So to qualify for benefits, you have to submit a letter in writing from your doctor that you need help with 2 activities of daily living, or that you have a severe cognitive impairment. And once that is submitted, I mean, they're going to review your medical records, but they're not sending their doctor out. It's your doctor's written certification, and they're going to review your doctor's records. So it really is an easy process, to get the coverage. So, and there's standardized memory tests, the Wechsler memory scale, which it's easy to get approved.
I was going to ask you that. Let's talk about the process. So, I refer someone to you, or they go to ltcpartner.com and they interact with Jack, you. Tell us about the process how are you going to qualify them? And let's talk about the underwriting, or what's needed, whether it's full underwriting or simplified issue. Can we go through that?
Right. Sure. I mean, well, my process is of course to first try to understand my client's concerns.
Right.
Right. Their objectives, why they're thinking about long-term care planning, what they're trying to accomplish. So
Mm-hmm.
I want to really learn about my clients, where they're at today and what's on their mind.
Mm-hmm.
So that's first of all.
Mm-hmm.
Of course, you buy the coverage not with your money. I mean, you buy the coverage with your health. So we really need to know that our clients, can health qualify for these policies. Right. So, I can, in 3 to 5 minutes, I'll be able to know if my clients can get a policy or not. I mean, I don't need, my clients to send me all their doctor's records right off the bat. I don't need them to fill out an extensive health questionnaire. Literally, within 3 minutes on the phone, if I know the prescribed medications, if I know the basic diagnoses and conditions that they've been treated for, I'll immediately know, which underwriter is perfect for them, what type of policy they will be able to health qualify for.
Mm-hmm.
So
that's what I love about
fairly
your
easy
process.
process.
You just shoot it straight. You're not going to waste anyone's time going down the rabbit hole if you don't think that they can get coverage. But if you do think they're going to get coverage, you're pretty much shopping all providers and carriers for the highest contractual guarantee, correct?
Oh, absolutely. Yes. And I would say about 95% of my applications get approved.
Okay.
Maybe higher. It's, if I'm submitting the application, we're going to get approvals. So,
because you've just been doing it, you understand it, and you handle that process turnkey for the client and walk them through each step. Because it sounds daunting, but I know your process and your best practices that you've put in place.
Right.
They're fantastic. Tell us about start to finish, and you can't give us a range of how long this process typically takes. And I guess you could break that down with product types, full underwriting, simplified, whatever. Can you give us kind of a ballpark on that?
Oh, yeah, absolutely. So again, this will depend upon which type of policy my clients are interested in, what they want to apply for. If my clients want the traditional standalone policy, medical records will always be ordered, always. So it's going to be a 4 to 6 week process to get an approval.
Okay.
Because we will need doctor's records, and we're at the mercy of the doctor to copy and forward the records.
Okay.
The asset-based policies can be a lot easier for underwriting. So with the asset-based policies, they will do a telephone interview. It lasts 30 to 40 minutes on the phone, a cognitive screening, so they give a memory test, 10 words, repeat the 10 words back, not difficult. And if they like everything that they hear on the transcribed telephone health interview, I can get an approval in 3 days.
So in the they that you're mentioning, that is actually a representative from that issuing carrier. Am I correct?
It's usually a vendor today.
Okay.
So it's usually a vendor that will collect the information that gets transcribed to my underwriter, who then has the transcribed interview and either approves, again, 3 days and we have an approval. Or if my underwriter reviews everything and there's medical information that they need to dot the I's, cross the T's, they will order medical records. So I would say about 60 to 70% of my clients get approved right after the telephone interview.
Okay.
But, of course, everyone has, some type of medical health history. So if an underwriter wants to go and order records from a primary care physician, maybe to look at, T-scores, to see if there's osteoporosis, or they may want to, it could be any number of medical issues that they just want to make sure that everything's fine, depending upon medical history. So if they want that, then okay, it could be, 3 to 4 weeks to get the records if they need medical records. But it's an easy process. Generally speaking, there's no exams.
Okay.
There's no blood. There's
nobody's showing up
samples.
no nurse is showing up at your door on a Saturday wanting to take blood.
Right. Now I've got one underwriter out of the 13 that I work with where if they need medical records, they actually do send an examiner to the house to collect height, weight, blood pressure.
Sure.
So no blood, but so it depends upon which underwriter we're using and what their specific guidelines are. But for the most part, half hour on the phone, telephone interview, and often we have approvals right after the interview. So.
Tell us about ages. Like how young is too young? How old is too old?
Well, the best time to look into this is when you're concerned about it. And when you're healthy enough to qualify. I have clients that, the biggest policy I ever wrote was for a client who was 37 years old.
Wow.
And his sister, who was a few years older, had been diagnosed with early Parkinson's. He bought the biggest policy I've ever written in 24 years. That being said, most of my clients are probably between the ages of 50 and 65, give or
Okay.
take. That's probably the sweet spot. And again, I have clients in their 70s, and later 60s and 70s, and I have clients in their 40s. But
Okay.
I would say the sweet spot for planning, probably 50s and 60s, because usually the catalyst for most of my clients when they call me, usually they're taking care of mom and dad.
Yeah.
And that's the eye opener.
It's a wake up call. Yeah. When you have to,
That's right.
yeah, I went through that with my father before he passed, when you have to do some things for your father that you can never imagine, clean up after him, etc. It does make you think about, oh my goodness, I don't want this to happen, etc. It is a wake up call. So people that, there's really no age range. It just sounds like when you want to check off that box and transfer that risk, because annuities are transfer of risk products. Long-term care is certainly a transfer of risk product. You're transferring the risk to the carrier. What
Yeah,
else?
there's no specific age, and that's something. I mean, sometimes there's consumer gurus, or they like to call themselves. Well, they'll say, on the radio, Dave Ramsey's one of them. Don't buy long-term care insurance until you turn 60. You need to wait.
That's just
And
crazy. You can't say that. That's absolute nuts.
Absolutely right. The worst advice in the world, and he doesn't know what he's talking about,
Yeah.
first of all. But when that advice gets sent out to people think, I don't need to do this till I'm 60.
It's malpractice. It's absolute malpractice. I mean, you can say it any way you want to, and I'm sure he believes in what he said, but he's absolutely incorrect. I did a recent YouTube video just kind of going factually through his annuity presentation, which was factually incorrect as well. So people just need to be careful on the advisors out there that are flying at the 30,000 foot level, because they're just giving broad brush statements that aren't true and don't make sense. Jack and I both like what Dave is doing with getting people out of debt. That's honorable and that's fantastic work. But the other stuff, with specific products and strategies, he needs to leave to the experts like Jack and myself. Hey, let's talk about life insurance, and let's just kind of go through the asset-based two types, annuities and life insurance. I'm very interested to hear you talk about the life insurance asset-based part and long-term care. Can you start at the beginning and just educate the listeners and viewers of this podcast?
Oh, absolutely. So, yeah, the life insurance-based policies, I mean, they are absolutely terrific today, because they've really morphed into what they really are today. I mean, they're not meant at all for life insurance. That's just the chassis. That's the car that's carrying the money down the road as we grow older.
Got it.
So, these policies are inflation-adjusted, tax-free long-term care plans. That's what we're buying. We're buying inflation-adjusted, tax-free long-term care benefits for a fixed cost with return of premium if you don't need it. That's what they are. And the life insurance policies, these policies, they can be funded in so many ways. Single premium, where you just write one check and you're done. Or you can fund the policies through tax-free 1035 exchanges from cash value from in-force life insurance policies you may have that you don't need anymore.
Right.
Or you could fund the premiums over 5 years or 10 years if you just want to fund it out of income. You can use IRA rollovers, at least with one company, to get the money into the policy. So, I mean, so many ways to fund it.
Wow.
So what we're usually doing is first talking plan, how much coverage, do we think we want? And then we can look at all the different ways to get the money into the plan, whether it's writing a check, single premium, spreading premiums out over time, or, using like qualified money. But the leverage that we get in these plans, I mean, to give you an idea, not to, but, so let's say someone has $100,000, and they write a check, and let's just pretend, let's say husband and wife are 60 years old. They could write a check for $100,000 and they could buy a policy, at age 60 that at age 85, when they're likely to need care, is going to provide $700,000, $800,000, $850,000, just depending upon the inflation factors that we're using.
Wow.
You're getting 7 to 8 to 1 leverage on the money if you need care, or
it's contractual.
You get your $100,000 back at death. So.
Yeah, and I think probably the only, because I can just hear the consumer right now because they want to have their cake and eat it too, and it's never like that. Is the downside in someone's eyes, but it's not in mine because you just explained the upside. Is there's no growth portion on that 100,000. You get your money back if you don't use it, which I think is fantastic with a 7 to 8 times leverage that's contractual. I think that's great. I don't know what the argument, but I'm assuming that's the only argument you get, right?
Well, I don't get arguments because people calling me want long-term care coverage. I mean, that's the reason they're calling me to begin with.
Well, you may argument might be the word.
Well, I'm not trying to sell somebody anything and opening up conversations. They're already calling me because they want the coverage. So I'm trying to maximize their dollars. But you're right. If someone thinks, wow, I spend $100,000 and all I'm going to get back is $100. Yes, it's a 0% return, but again, you could get $700,000 or $900,000 in living benefits. Listen, if you just want to maximize the 100 and not have the 700,000 or 800,000, well, I mean, an insurance company today would probably just say, all right, we'll give you $200,000 at death. That's it. You can use it for care.
Right.
You can use it for life insurance. But if you're 60 years old and you give us 100, hey, a 3% return in 25 years, all you're going to have is 200. So
you got it.
The net amount at risk is 100, and you're maxing out at 2, and that's not exciting. That's not leverage.
To me, it's a no-brainer. You're putting in this case 100. You're guaranteeing that transfer of risk amount in the future. The downside is you get your 100 back, right?
Right. That's right. That's right. You give up a little bit of growth. That's nothing to sing about anyway.
Right.
I mean, there's nothing we can do. Laddering CDs, or I mean, you can make money 3%. I mean, if you're that's fine.
Sure.
But you're not going to get 800,000.
No. And so the life insurance is nothing more than a cost-effective and efficient delivery system for the long-term care benefits that are contractual. Correct?
Correct. That's it. That's it. So it's great leverage, if you're looking to have tax-free benefits for long-term care planning, as a separate bucket from your investment side, from your safe money side, from your income side, so we're using money that's not needed for income. That's the first thing, right?
It's non-correlated.
That's right.
Yeah.
We're not using income money. We're using money that's a separate bucket.
So let's talk about the other asset-based type, which would be annuities. And let me just tell people real quick about the annuities on my side, which, I only sell contractual guarantees. And there are what's called income riders attached to policies that will say that it's confinement care, nursing home care, or enhanced benefit. And it's guaranteed issue. You don't have to do anything, to get it. And that should tell you all you need to know. It's not primary coverage. It's a supplemental only thought. And even then, I would still refer you to Jack to get real long-term care. So let's go through what you have on the annuity side that's real long-term care.
Right. So the asset-based annuities, similar to the asset-based life insurance, right? We're getting extended coverage past the amount we're depositing. So typically the underwriters they'll triple your money right off the bat. 100,000 is automatically 300,000 for long-term care.
Got it.
We can put inflation protection in the policies to some extent as well. So again, if we want to, we're getting inflation-adjusted long-term care benefits. If we buy the inflation on the annuity side, that comes out of cash value. So if we write a check for 100. Okay, cash value is now probably 70, 75. I mean, you're paying then for the inflation. So where we use the annuity approach, quite frankly, is if our clients are much older,
Mm-hmm.
okay, typically in their 70s, or they're just, if they're not in good health, if their health won't allow them to get the asset-based life insurance contracts, because there's more underwriting on the life insurance contract. So if you're in good health, and certainly if you're under 70, 72 years old, we're going to be using the life insurance asset-based policies, absolutely.
Gotcha.
But if health is compromised, or if you're older, where the mortality costs of the life insurance policy have now crossed over to be very cost prohibitive, well, we have the annuity policies that will be able to give you, 6 years of coverage. I have some contracts that would even be lifetime unlimited, with both the annuity or the life insurance approach. So we can use either avenue to get the coverage, but we're usually leading with the life insurance approach because most of the time our clients are healthy enough to get it. So
let's talk about the structuring of the policies. Is it just single life, or are there opportunities and vehicles and asset-based life insurance and annuities that you can do a joint policy with your spouse or partner?
yes. All companies offer individual policies. I have one underwriter, One America. They will offer joint life. So, so we can, cover, partners, husband and wife, with one policy, which reduces cost, and they can each have their own individual benefits. So you're not sharing your monthly long-term care benefit with your partner or spouse. You each have your own individual coverage, but under one policy, a joint life policy.
Got it.
So yes, we can do that as well.
That's fantastic. Let's talk about our friends in Washington, D.C., because they're always got their little fingers in everything, and they're messing with things. And we're kind of headed toward that socialized medicine platform sooner than later. How is this, if at all, going to affect long-term care policies, in your opinion? Obviously, nobody knows the right answer, but if anyone's going to answer it, it's going to be you. So what do you think about that?
I can't see it providing comprehensive long-term care benefits, for everyone. The money isn't there in our Medicaid system, first of all, to cover it. We're, right now the states are trying to think of ways to incentivize people to private plan for long-term care. So how are we going to, cover long-term care costs, through the public sector that's of any significant value, really? The state of Washington right now just, is going through the process of passing a long-term care trust act for all of the residents through a payroll tax, but it's $100 a day for 1 year. That's it. That's the benefit. And that's the same benefit that in 2011, Senator Kennedy was trying to pass through the Class Act. To give everybody $100 a day for 1 year.
It's a great political speech, but it has absolutely no teeth to it once you dig in. That's lunacy.
It's so short. Listen, it's a little bit a help, but the cost of care today is $9,000 a month, $9,000 a month, and they're offering $3,000 a month, at least in Washington, for 1 year. So it's something, but it's going to be funded with a payroll tax, a pretty hefty payroll tax. So I don't know.
Yeah, there's no good answer, just bad sales pitches, as I always say, right?
Well, I think for our clients that do have assets,
yes,
and can plan, they need to plan, because the public benefits that will be available. Even if they come up with a small benefit for people, it's going to have strings attached, income qualifications, maybe. I don't know. I think it's just wise for everybody to plan. I can't see how the government will be able to pay for long-term care with the baby boomers at all. So
I hear you.
the
So
money's not there.
let's pivot to, and without mentioning any carrier names, do you see more carriers getting into this asset-based long-term care? I know that the traditional long-term care carriers there's not as many. Can you comment on the space from the standpoint of choice? Because I think another misconception out there about long-term care is there's just not many companies offering it, which means that there's just not a lot of competition. I'm assuming that's just dead wrong, correct?
Well, it is and it isn't. I
Okay.
mean, the traditional space is ridiculously small today. We just had 2 underwriters leave last month. We're down to 4 underwriters. 4.
And going back to traditional is I pay in, but if I don't use it, money goes poof, right?
That's right. We have 4 underwriters left. I had 120 underwriters when I began in 1998.
And there's 4 left.
There's 4 left.
In the traditional side, which
4. And 2 of the 4,
unbelievable.
and 2 of the 4, you would never buy a policy. The premiums are through the roof. So we really have 2.
Wow.
So the hybrid side, I'd say right now, I mean, it's a very healthy arena, but we probably have 7, 8 underwriters. I mean, we only need 1, but it's been growing. We've had a few new entrants in the past 2 years, and I'm sure we're absolutely going to get more entrants, absolutely, over the next 3 to 5 years, because it's where the market's going. But, right now we have a solid 8 companies that are, really, making the market in inflation-adjusted extension of benefit products. Not the riders on a life insurance policy, which are death benefit focused, but just the inflation-adjusted, asset-based long-term care policies. So, we have 8 solid companies, and they're all high-rated.
It would seem that with the demographic tidal wave of all these 10,000 baby boomers reaching age 65, that companies would certainly look into that. But there has to be a reason that they're not running past the door and through the door. Tell us about the regulation, because this is not the wild, wild west. Long-term care is so far from that. It's heavily regulated. Can you speak to that part of the business? Obviously, you manage that for your clients, and you go through the weeds and you deal with all that. But tell us about the regulation and the safety of the whole industry and how it's run.
Well, with all products, whether it's long-term care products, life insurance products,
Sure.
It's consumers are protected, up to state guarantee. We have state life and health guarantee associations, of course, so that if we ever have an insolvency with an insurance company, then the state will be the backstop up to state guarantee limits, which some states it can be unlimited. Some states like California might be 700,000 or 800,000, but we have significant backstops for insolvencies, and
Right.
none of the companies today are really at risk for insolvencies. So we have, and again, as far as like regulation with the contracts, all the contracts have to adhere to the Internal Revenue Code 7702B. So everything is standardized and codified from how the contracts can read, what the benefit triggers are, what has to be inside a contract for it to be considered long-term care insurance. So
I like that. I like the fact that there's a little bit of a heavy hand and a consistency within the industry based on that specific law that you mentioned, so that there's some. There's just, for the consumer, I think it's good. They don't have to. They don't have to learn everything about it. They can go to an expert like you who understands it back and forth, give them their specific situation, and then you can point them toward the solution that's going to provide the highest contractual guarantee.
But the reason we don't have 100 underwriters, the reason, again, we have on the asset-based side a solid 8 companies, but the reason is again, it's a very capital intensive
Yeah.
underwriting business. They're trying to predict a need for care that's for most people in their middle to later 80s. And if the buyers are in their 50s and 60s today, it's a hard business to underwrite. We pretty much know when people are going to die, but we don't know if they're going to need care and for how long. And to try to underwrite a healthy individual in their 50s or 60s and, try to project the risk at age 85 or 88, well, it's just a lot of insurance companies, they would rather just not have that risk, that actuary risk. And that's the main reason.
Yeah. And that's interesting. I read something a while back that said, and I want you to clarify if this is true or not, that when you cannot do 2 of the 6 daily functions of life, of which you talked about in the opening part of the podcast, that you live an average of 3 years and a maximum of 7. Is that in the ballpark or not?
It is. I mean, it's in the ballpark. It's just an average, but life doesn't work in averages.
No, I know that. I know that.
Yeah. So an average need today, and we're seeing through recent actuarial data that it's increasing. It's up to about 42 months right now.
Is it? Okay.
So the internet will tell you it's 3 years, but it's kind of going up to 3.5 right now.
There you go.
And 90% of claims will be less than 6. Okay, but again, 10% are going to be longer than 6, and we have cognitive impairments, Alzheimer's, dementia, or Parkinson's disease is another. Where you can need care for a very long time.
And that's the benefit proposition of transferring risk. I mean, in a nutshell, you don't know, so why not cover yourself and transfer the risk to the carrier? Question about the time of this taping, and we're in the middle, hopefully at the going downward toward the COVID end, but I doubt it. Has COVID affected anything in your business?
Oh my God, yes. I mean, it absolutely did. I mean, significantly. So
Explain
last year, well, in March when COVID happened, across the board, all of the underwriters pulled product for applicants, or restricted it for applicants 70 and over. So because again, the risk, if you're older and you got COVID, you could have a higher risk of passing away.
Right.
So absolutely, they did restrict issue, and they tightened up underwriting, and it has now just started to open back up again with the vaccinations. The underwriters are, for the most part, business as usual, although there's one or two underwriters that still haven't completely opened it back up to applicants in their 70s. So we definitely had impact there for sure.
So things are kind of calming down a little bit and getting back to normal, but you can understand the underwriters and the carriers. The unknown was the unknown. It's blue water.
Right.
Never been there before. So
that's right. So everything was very tight last year for a solid 6 months, but now we're back to ordinary business again.
Good.
Thankfully.
We got a few minutes left, but I wanted to go through and just ask you, what are some of the questions that you would like to address, or some of the issues you'd like to address that we have? And we covered a lot of ground, and this isn't the last time Jack's going to be on the program. But what would you like to address about long-term care? Maybe it's misconceptions, maybe it's common questions. I don't know. Just fill in the blanks of what we haven't filled in so far.
Well, I mean, most of my clients, the questions that they have really, relate around, I mean, again, what we have discussed though, how do they qualify for benefits? How do they know, will the company be there for them in 25 years?
Good question.
I mean, the typical concerns about, will a company be solvent? Can the premiums change, et cetera, which again is more on the traditional side than the asset-based side. A big question I get today is at claim time, what is the process of collecting benefits? And there's a couple of different policy types today, which, it's changed from the past. In the past, the primary policy is a reimbursement model where you actually have to submit receipts, right? You have to show that you have a proof of loss to receive benefits, and then you're reimbursed for your out-of-pocket costs. So a lot of my clients today, a question they have is, well, can my daughter take care of me? What if I want a family member to help me out, et cetera? So we have a couple of policies, not many, but we have a couple of policies today that have the utmost flexibility. They're called cash indemnity policies, no restrictions. If you need care, anybody can be your caregiver. Your daughter can take care of you if needed. They're just going to give you the cash. You don't have to even show that you came out of pocket and paid a caregiver. So that's been one of the changes, and it's a concern, for a number of my clients, having the flexibility with the policies to receive the benefits with, no questions asked and not having to use an agency for home care, et cetera. So that's a question that I receive a lot.
Do they get a hard copy policy at the end of the process?
Oh, always. Absolutely.
They get a hard copy policy. Is there a free look provision with long-term care?
There's a free look provision of 30 days in every state. So the typical process, underwriting offers are good for 60 days. You do not have to submit money with an application. Okay. Every underwriter will issue a policy without money. And then I'll FedEx the policy to my clients. They can pay for it when they want. Once they write the check, they then have 30 days, to get their money back after, whatever the date is on the delivery receipt and the check. Sure, they would have a 30-day free look period to ask for their money back. 24 years, I've never had a client ask for their money back. So,
but that with a lot of my listeners across the country, and I'm licensed in all 50 states and do national business like you do, a lot of people just really don't know the basics of long-term care. And with this first interview with you, I wanted to cover really just some fundamentals and some basics and some questions that people probably had in their back of their mind, but never really wanted to ask and didn't know how to ask it. And hopefully we have done this during today's program. I want to encourage people to go to Jack's site, reach out to him. It's LTC, just like long-term care, LTC Partner, PARTNER.com. So LTCPartner.com. And like me, Jack answers his phones, and he's the guy that's going to be working with you one-on-one with decades and decades of experience and a law degree behind it, which I think is just fantastic. We will be having Jack on in the future. And with future interviews, we're going to be going into and doing some examples of some cases and things like that. But for this one, Jack, you've hit a home run. I don't know if you played baseball. You are based in the Atlanta area, but
I was basketball like you, Stan.
Hey, I shoot free throws and you hit home runs. So, between the two of us, we're pretty tough. But I really appreciate you being on Fun with Annuities. Any closing words before I close this thing out?
Well, I just appreciate the opportunity to help all of your clients, Stan. What you do is tremendous for everyone. You're the best in the business by far. And,
I can say the same thing about you, Jack Lenenberg. I tell you what, he is the source and the thought leader for long-term care. And I'm not just saying that because he's on. He knows that's how I think. And my hope is that more and more people will find you. I mean, you're already busy as heck, but I do encourage my listeners and viewers, as people know, this is on all podcast platforms. We also film it on Fun with Annuities YouTube channel. Jack wasn't able to show us his mug this time because he's traveling, but next time you'll be able to see Jack interact. But Jack, I really appreciate you being with us. And for all you listeners and viewers out there, I'll see you next week on Fun with Annuities. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site, at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.